Hi, this is Drew Tignanelli, and this is a client update for November 9th, 2010. And you may be thinking, Drew, why are you doing a client update? Because there's nothing bad going on, it's only good. Market's going higher, and we're all making money. So you're just here to tell us that everything's going good and just hang on because everybody's going to make a lot of money? And the answer is, it's really good that the market's doing well and we've participated in it. But you need to keep a close eye on the exit door in this market. There's still plenty of dangers out there. One of them that's starting to manifest itself is, again, sovereign debt in Europe. Now, to understand this, you have to go back a few weeks ago, and Germany made a proposal in the European or the Euro bloc nations that we're not going to bail out countries anymore, starting 2013. Now, so they've already agreed. They've got a $1 trillion bailout fund for countries, and Greece has already tapped it. But nobody else has tapped it, and the fund is available to 2013. Well, at the end of 2013, Germany's passed this proposal to say, if you need a bailout, we're not going to give you one. And you'll just have to go into default, and bondholders are going to lose money and so forth. So what are bond investors doing in 2010? They're getting prepared for 2013 by requiring higher rates of return from countries that they perceive as risky. Greece is up to about an 11% interest rate. Ireland is up to about 8%. Spain has now been pushed up to about 5 or 6%, compared to Germany, which is the safest, which is only yielding, paying about 2.5%. So the point is that Europe is starting to become an issue again. And you saw what happened in the early part of this year when Europe, when they got concerned the European bloc nations could be in trouble, and you could see an unraveling of the euro. So right now, you also have another issue, and that is that the emerging market nations are starting to say, you know, the U.S. is printing a lot of money, and it's coming to our nations, and it's overheating our nations, and we're experiencing inflation. Whether the United States is experiencing inflation right now or not, we are. And so they're trying to cool their economies down, raising interest rates, and trying to get their economies not to inflate as fast. You saw Australia raise rates, you saw Brazil raise rates, India raise rates, China raise rates. So you now have this other parts of the world trying to slow their economies down. And so there's plenty of danger out there. I think that China and Asia, you know, they're still doing okay, and I think they'll continue to do all right. And I think commodities are a very sound investment still. I think dividend-paying stocks and currencies in the right countries are going to be good investments. But I think you're going to have to be very careful with stocks in general. And that brings us to your 401k account. If you want to be conservative, now's the time to start making sure that you go back into a little more conservative posture. If you want to be moderate, I think you ought to pull back just a little bit right now. And if you want to be growth oriented, you may be able to wait until January of next year before you start really pulling back. But I can't tell you when this thing's going to blow again, but there's still danger out there. You need to be very cautious, and you're going to start seeing us pull back to some degree. But we have the ability to be much more traders than you do, especially in your 401ks that we don't control. So anyway, if you have any questions, feel free to call us and ask. Otherwise, it's Drew Tignanelli saying God bless.